Good morning, everyone, and welcome. I call this meeting of the Ncua Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided web link cast. I would also like to note that all of the participants in today's webcast are participating remotely. So if we experience technical difficulties, I ask for your patience. The first item on our agenda today is a board briefing about the Share Insurance Fund quarterly report. Staff presenting is Eugene Sheed, Chief Financial Officer, and staff available for questions include Andy Leventis, Chief Economist, Saurabh Datta, Economist, Office of the Chief Economist, Myra Tepe, Director, Office of Examination and Insurance, and Russell Moore, Risk Manager, Office of Examination and Insurance. Eugene, you may begin when you're ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. This is Eugene Sheed, and I'm here to present the 2021 second quarter financial statistics for the Share Insurance Fund. Slide 2. This table shows the Share Insurance Fund's revenues and expenses for the second quarter of 2021. For the quarter ended June 30th, the fund recorded net income of $46.3 million. Total income of $60 million primarily consists of investment income from Treasury securities, which was $59 million. And additional income sources include $0.8 million from interest revenue on optional AME purchase agreements and $0.2 million collected for guaranteed fees on the NCUA's guaranteed notes, or NGNs. On June 14th, 2021, the last outstanding NCUA guaranteed note trust matured. Operating expenses were $51.1 million for this quarter. The provision for insurance loss reserve expenses decreased by $2.6 million during the quarter. I will discuss this further when I get to slide 4. The AME loss for natural person credit unions and corporate credit unions decreased by $7.9 million and $26.9 million, respectively, due to favorable changes in estimates of future cash flows of assets held by certain asset management estates. Slide 3. This table shows the Share Insurance Fund's balance sheet as of June 30th compared to the previous quarter. As of June 30th, total assets were valued at $19.8 billion, of which 97% are funds held with the U.S. Treasury and cash overnight investments in long-term Treasury notes. Overall, total assets increased by $52.5 million, largely due to an increase in the interest revenue of Treasury investments. The net receivable from the asset management estates is $426.9 million. The receivable from the natural person credit union asset management estates decreased by $0.5 million from the last quarter due to cash collections and recoveries. The receivable from the corporate credit union asset management estates decreased by $0.4 million, primarily due to cash collections partially offset by cash outflows for an NGN optional purchase and the increase in future cash that we expect to collect. Accrued interest and other assets is $96.3 million, which increased 7% from the last quarter, largely due to an increase in Treasury interest receivable. Total liabilities are $166.4 million, or 1% of total assets. Accounts payable and other liabilities of $5.3 million primarily consists of credit union disbursements of $4 million. The fund's net position is comprised of capital deposits, which represent the total balance of all federally insured credit unions' 1% capitalization deposit and the cumulative results of operation. Net capital deposit activity increased by $4 million this quarter. Cumulative results of operations increased $72.6 million during the quarter due to an increase in unrealized gains on investments of $26.3 million and the $46.3 million in net income for the quarter that we saw on the previous slide. Slide 4. The SIF records an insurance program liability, which is comprised of general and specific reserves to cover losses resulting from insured credit union failures. Each quarter, the SIF assesses the reserve needs of credit union failures to make a reasonable estimate of losses. During the quarter, the reserve expense decreased by $2.6 million, primarily due to a decrease in the general reserve and partially offset by an increase in specific reserves. At the quarter end, the total reserves were $161.1 million, and that consisted of $9.1 million in specific reserves and $152 million in general reserves. Slide 5. Through the second quarter of 2021, there were 3 credit union failures that incurred a loss to the fund. There was 1 involuntary liquidation with a purchase and assumption and 2 assisted mergers. The cost of the failures for 2021 was $3.5 million. Fraud was a contributing factor in 1 of the 3 failures. Slide 6. As of June 30th, 2021, the Share Insurance Fund had $18.4 billion at par value invested in Treasury securities with maturities out to May 2028. The weighted average life of securities held by the fund is 3.4 years. The weighted average yield of securities held by the fund decreased 2 basis points from the last quarter to 1.24%. The lower bar chart on the slide shows the cumulative picture of how much of the portfolio will mature over time. About 72% of the portfolio will mature over the next 5 years. During the second quarter of 2021, 3 Treasury notes matured in the amount of $450 million. These securities had yields ranging from 1.49% to 1.99%. Slide 7. The next several slides will review the Camel data as of June 30th, 2021. Slide 7 shows the distribution of insured shares by Camel Codes from 2016 through the second quarter of 2021. In the area graph at the upper portion of this slide, the red portion of the graph is the percentage of total credit union assets that are Camel coded 4 or 5. The green represents the percentage of Camel assets in code 3, and the blue represents the percentage of credit unions that are Camel coded 1 or 2. The chart underneath the graph displays the total number of credit unions by their respective Camel codes. The total share represented by credit unions that are Camel code 4 or 5 is $8.3 billion, or 0.49% of all insured shares. This represents a decrease of 8 basis points from the prior quarter. Total shares represented by credit unions that are Camel code 3 are $42.6 billion, or 2.48% of all insured shares. This is an increase of 2 basis points from the prior quarter. Total shares represented by credit unions that are Camel code 1 and 2 are $1.7 trillion, or 97.03% of all insured shares. This is an increase of 6 basis points from the prior quarter. Slide 8. This slide compares the credit union's Camel codes by asset size. Camel code 4 and 5 credit unions are shown on the left-hand side, whereas Camel code 3 credit unions are displayed on the right-hand side of the graph. Comparing Camel code 4 and 5 credit unions by asset size from March 2021 to June 2021, The number of credit unions with total assets in all categories less than $500 million increased during the quarter, whereas the number of Camel Code 4 and 5 credit unions with more than $500 million in total assets remained the same during the quarter. Total insured shares for Camel Code 4 and 5 credit unions decreased from $9 billion to $8.3 billion during the quarter. Total assets also decreased during the quarter for credit unions coded Camel 4 and 5 from $9.8 billion to $9.1 billion. Comparing Camel Code 3 credit unions by asset size from March 2021 to June 2021, the number of credit unions and asset categories from $10 million to $100 million and $100 million to $500 million increased during the quarter. The number of credit unions with asset categories less than $10 million and from $500 million to $1 billion decreased during the quarter, whereas the number of credit unions with assets greater than $1 billion remained the same during the quarter. For credit unions coded Camel 3, insured shares increased from $38.9 billion to $42.6 billion, and total assets also increased from $44.4 billion to $48.1 billion. Slide 9. This slide shows the distribution of assets by Camel Code from December 2006 through June 2021. As in Slide 9, the red portion of the chart is the percentage of credit unions' assets that are Camel Coded 4 and 5. The green represents that which are Camel Code 3, and the blue represents the percentage of credit unions that are Camel Coded 1 and 2. The distribution of all assets over the last quarter for Camel 1 and 2, 3, and Camel 4 and 5 remained the same at 97.1%, 2.4%, and 0.5% respectively. There was no change from the previous quarter. Slide 10. Turning to the equity ratio chart, the current equity ratio was calculated as of June 30th, 2021. Per policy, the equity ratio is updated on a semi-annual basis. The current equity ratio is 1.23%, a decrease of 3 basis points from December 2020, and was calculated using an insured share base of $1.58 trillion. The blue line running across the chart represents the normal operating level, which remains at 1.38%. Slide 11. The Ncua staff projects the equity ratio as of June 30th and for December 31st per policy. The projection calculates the equity ratio on the same basis as the actual equity ratio, and that formula is shown in the middle of the graphic. The 6-month projection for the Share Insurance Fund equity ratio is 1.28% at the period ending December 31st, 2021. Key factors behind the projected increase in the equity ratio are a lower projected increase in insured shares as compared to what has been seen in recent quarters, and the effect of the semi-annual capital deposit adjustment true-up, which will be collected in October. Slide 12. This concludes my presentation. I and my colleagues from E&I and the Office of the Chief Economist are available to take your questions. Thank you.
Thank you, Eugene, for your update on the performance of the Share Insurance Fund in the second quarter. I would also like to thank everyone on your team, as well as those in the Office of the Chief Economist and the Office of Examination and Insurance for their good work in putting together today's board briefing. During the second quarter of 2021, the credit union system as a whole remained on a solid footing. That is good news. But while the economic outlook also showed signs of improvement in the first half of the year, COVID-19 pandemic relief programs have started coming to an end, and the Delta variant has led to a rising caseload in many communities in the third quarter. Additionally, the pandemic's disruptions hit lower income households and communities of color the hardest. For individuals in these groups, the recovery could take longer. As such, much remains uncertain for members and their credit unions in the months ahead. The top priority for credit unions should be managing the operational and financial risks while continuing to work with members who are struggling. But nevertheless, we ultimately should expect delinquencies and charge-offs to rise in the months ahead, and all credit unions should pay careful attention to these matters. To protect the Share Insurance Fund and ultimately taxpayers against losses, the NCUA needs to stay on top of these emerging risks and problems in the credit union system. On that note, I am pleased that the Share Insurance Fund equity ratio came in at 1.23% as of June 30th. The actual ratio was within a hair's breadth of the projected ratio of 1.22%. I say a hair's breadth because we got to the actual 1.23% ratio by rounding up, and to the projected 1.22% ratio by rounding down. In making this nearly spot-on projection of less than a basis point, NCUA staff has demonstrated that we are acting as a good steward of the Share Insurance Fund. Going forward, we need to stay focused on the equity ratio, because if it falls or is projected to fall below 1.20%, the NCUA board must develop a restoration plan. So my first question is about the equity ratio. On slide 11, I see that the 6-month projection for the Share Insurance Fund equity ratio is 1.28%. Does this indicate that the equity ratio is actually improving? What has been the long-term trend for the equity ratio?
Thank you, Chairman. This is Eugene Sheet, and I'll address that question. So I would say that it's a sign that the equity ratio is catching up to the growth. So I mentioned that we'd be that factoring into the December 31st is the capitalization 1% true-up, and we'll be collecting a little over $1 billion in October. That combined with lower projected growth as compared to recent quarters is what really brings up the equity ratio. So I think it's more that it's catching up in things. Economic outlook is a bit more back to what we have seen historically versus it sort of improving, because for it to be improving, we still have, I think, the long-term dynamic that is displayed on the previous slide, slide 10, where the long-term trajectory since 2017 continues to be downward. And that's going to, I think, continue that way as long as we have relatively low earnings from the Treasury investments and low interest rates. That concludes my answer.
Eugene, thank you for those observations. Turning now to slide 3, I see that the net position of the Share Insurance Fund is just under $5 billion. That seems like a low figure, given the credit union system is now a $2 trillion industry with $1.6 trillion in insured shares. Do we have any room for error in managing the fund? What could happen if we had several sizable credit union failures and needed to dip into the 1% capital deposit? Eugene, this isn't a hypothetical question for me. I remember the last financial crisis when Congress had to act to create a temporary corporate credit union stabilization fund. If we had not done that, we would have had to immediately write down 69 basis points of the 1% capital deposit. That write-down could have led to a cascade of losses as credit unions trued up their capital deposits with the Share Insurance Fund, only to have another credit union get into trouble and having another true-up occurring. Eugene, would you explain why it is essential to have sufficient reserves in the net position to handle future losses without dipping into the 1% capital deposit?
Sure. This is Eugene, and a couple of questions there. So I guess I'd start to frame it this way, which is kind of, with your observations about on slide number 3 in the equity of the fund, the cumulative results is shown on slide 3, compared to total system assets is largely what the normal operating level, the equity ratios based on, and it's still well below, as was seen on the previous slide, slide number 10, still well below the normal operating levels defined by the board. And that normal operating level, I think, to me, is what sort of defines that cushion. So we're well below kind of that cushion area to absorb a medium-sized economic downturn. You're referencing in your question the downturn in 2007, 2008, which was a much sizable, the largest downturn in losses that the fund has seen, which had Congress not stepped in and we didn't create the temporary corporate credit union stabilization fund, would have taken the equity ratio below 1%. Credit unions would have had their deposits impaired, and there would have been sort of a double whammy of having to restore the fund at a time when the system is seeing losses and their deposits are being impaired. So I think that's that in and of itself is sort of the reason for paying attention to how much of a sort of operating level we have above the 1% and above the 1.2%, and continuing to assess that in terms of what margin should we have and under what scenarios to withstand an economic shock to the share insurance fund. I hope that addresses your question, sir, and that concludes my answer.
It does. I really appreciate your assessment there. If we could jump to slide 8, I see that total assets of composite Camel 3 code credit unions rose for the second quarter in a row for credit unions in the asset bucket, starting with the 10 million to 100 million, but also the 100 million to 500 million and the 500 million to 1 billion. What is driving this increase?
So the changes in the aggregate Camel information that we show is really a mix of credit unions moving in all directions. So there's a mix of Camel Codes 4 and 5 that improve to 3s and 1s and 2s that move up to 3, and likewise 3s that move up and 3s that move down. You are correct that in aggregate, the number of Camel Code 3 credit unions increased during the quarter, although by a fairly small amount. I think overall the Camel picture indicates that from a Camel perspective, the system remains fairly solid, but as we've discussed at previous presentations, looking at some of the underlying movements, continues to be a cause for sort of vigilance and concern, particularly in some of those credit unions that are seeing those shifts. That concludes my response.
Thank you, Eugene. And I have one last quick question on slide 2. I see that the guarantee fee revenue has dropped by $400,000 quarter over quarter. Is that because the Ncua guaranteed notes program is winding down? Should we expect further decreases in this balance sheet line item in future reports?
So yes, sir. This does reflect the wind down, and it will continue to have a diminishing impact on the financial statements as we bring it to conclusion. That concludes my response.
Thank you, Eugene. That concludes my remarks. I now recognize Vice Chairman Hauptman for his comments. Vice Chairman Hauptman, you may want to unmute.
There we go. Okay. Well, at least we both did that today. But you may regret taking me off mute. Today's report is good news. At the February and May board meetings, I said credit unions should stay focused on the needs of credit union members and not on NCUA's understandable concerns about the future. Our caution served us well. As we know, the decline in the SIF's equity ratio was not due to unsafe or risky practices by credit unions. It was the result of government stimulus and other pandemic-related issues. Thankfully, the decline in the equity ratio through June 30 was a little less than expected, and we are projecting that it will increase by year-end. Over the past year, credit unions continue to remind us that what we do here has an impact on real human beings. If we had acted prematurely, we would have made ourselves more comfortable, but might have taken away resources from credit unions that during the pandemic might better be spent helping an untold number of members. That said, I have to admit that it is indisputably uncomfortable for the fund to again be so close to our lower limit of 1.2. Neither credit unions nor Ncua staff would enjoy an existence where we're constantly on edge, worried that we're one small dip away from announcing a mandatory restoration plan. So if our projections are accurate, we'll soon have some breathing room and thus be able to reassess the fund's status after all the pandemic-related factors fade away. And lastly, I'd be remiss without mentioning the fund's investments. We are in a low-rate world, and that's just something we have to deal with. And our low returns in the fund add pressure that is not the fault of Ncua or credit union members. But credit unions regularly review their investment policies. A review of our investment policy is part of sound management. Although the current low-rate environment presents challenges, reviewing our investment policy is something that could be worthwhile, since it's incumbent upon us to look for every dollar we can find. Thank you, Mr. Chairman. That concludes my remarks, and I have a couple questions for Eugene and his colleagues. The first is, it's reassuring but not surprising to see 97% of insured shares are held in credit unions with Camel 1 or 2. Those are our top ratings. That's good for members and for the health of the share insurance fund. Can you tell me, review what goes into the calculation for projected losses to the fund?
Yes, Vice Chairman Hopman, this is Myra Tepe. The calculation for the projected equity ratio includes the fund's 5-year average loss history, excluding losses incurred for Melrose Credit Union. That includes my response.
Thank you. And so I understand we use external economic predictors and individual credit union data to predict estimated losses. How is the econometric reserve model audited? Or specifically, how are the assumptions that go into the model audited in terms of how it plays out in real life?
This is Risk Officer Russell Moore. E&I uses a third-party developed econometric model to predict the potential level of losses for credit unions without specific reserves. For general loss reserve requirements, the risk profile categories are established, and probable failure and loss rates are forecasted using a set of econometric models that take into account Camel ratings, credit union level financial ratios, and macroeconomic conditions. The macroeconomic factors are the Consumer Price Index, the 3-month Treasury bill rate, the National Purchase-Only Housing Price Index, and state-level housing price indices. We utilize a third-party provider who updates the model coefficients using the latest macroeconomic indicators and the credit union level data. This third-party provider also performs a parallel run each quarter, and E&I compares its results to this run. Differences, if there are any, are investigated and resolved. The model is audited annually by the CPA firm engaged to audit the fund. Our CPAs review the model every year during the audit. This concludes my answer.
Thank you for that. Yeah, I think what some people ask us is if we are consistently being too conservative of our end and our projected losses wind up being less, that obviously would affect the equity ratio. That's what I was sort of getting at. But yes, it is a well thought out model. And last question, as a general matter, $1 in the SIF earning what we earn, or $1 at a credit union, which of those earns a higher return in general?
This is Myra Tepe, E&I Director. I think it would depend on what the investment yields are. So in the SIF, we are only allowed to invest through Fed Invest. So we're only allowed to invest in Treasury securities. So credit unions actually have a different policy relative to what they're allowed to invest in. They invest in loans, other securities, things that we cannot do with at Ncua. So that concludes my response, sir.
That's right. And I think the performance shows that they earn a higher return because, like you said, we're just in treasuries and they can invest in other things. So my point being, a given dollar at a credit union, all else equal, makes the system overall stronger than a given dollar in the SIF. I understand we have to have money in the SIF. That's what it's there for. I'm just trying to make the point that if a dollar lives at a credit union, the system as a whole tends to get stronger because it earns a higher yield than it does at the SIF. That concludes my questions. Back to you, Mr. Chairman.
Thank you so much, Vice Chairman Hauptman. And, this is a bit of a Goldilocks problem as I see it. You don't want too much, you don't want too little, you want to find where we are just right in the middle. So, Board Member Hood, do you have anything that you would want to add or ask?
Yes, thank you, Chairman Harper. And before I begin, I would like to welcome all of our NCUA colleagues back. I recognize it's been since July since we were all together for a board meeting. So I hope you all have returned to the agency energized and recharged, and I hope you and your families are all healthy and well. Eugene, I certainly want to thank you for today's presentation, along with those who assisted you from the Office of the Chief Economist and from E&I. But I'd like to thank the credit unions for the strong performance that they have posted in helping us get to the results that we've been able to see from today's Share Insurance Fund report. And that is from slide 9, Eugene, which you provided us with earlier. I'm delighted that over 97.15% of our credit unions are Camel Code at 1 and 2 that really represent nearly $2 trillion in assets. And this is buttressed and undergirded by strong credit union performance amid a lot of the headwinds that we've seen through the pandemic and also through high unemployment. And that is, credit unions were still able to do a yeoman's job. And one is evidenced by our second quarter call report, net worth increasing over $18.1 billion or 9.9% year over year to now $201 billion for an aggregate net worth ratio, of 10.17%. That's roughly 317 basis points beyond our statutory requirement of 7%. Very pleased that credit unions are continuing to not only lend to their member owners when they need loans, but doing so in a methodical, pragmatic manner, as evidenced by a delinquency rate that has decreased 46 basis points. Well, actually, it's now 46 basis points, down 12 basis points year over year. And in addition, I was very pleased to see from our second quarter call report data that net income has increased. Yes, it's a low interest rate environment, but net income has been able to climb $21.3 billion, roughly up $11.9 billion, or 126.8% year over year. So I guess I want to just let everyone know, yes, we have a strong performance, and it's evidenced by the great work that our credit unions are doing each and every day. Now, as I shift, Eugene, to some of the questions I'm going to have for you, before I move to questions, I want to repeat something that I've said at a previous board meeting. The NCUA's insurance model is a very different premium model than the FDIC's model. Premiums are the only recourse for the FDIC and the normal operating level. Credit unions are indeed legally committed and bound to update a large majority of the fund's equity contribution. Credit unions today provide the bulk of the capital contributions that are the basis of the fund's soundness, which we've heard articulated by Eugene earlier this morning. This belief also guides me in saying that this is the time for the board to consider the National Credit Union Share Insurance Fund investment policy to identify options for effective board decisions regarding the fund. This has been especially relevant as we have seen the fluctuation in Treasury yields since the start of the COVID pandemic. Eugene, is the latest investment policy public?
This is Eugene. And so this came to my attention yesterday that the policy that the board approved in 2013 does not seem to be available publicly, at least on our website and from what searching I could do. Understanding that the investment policy is an item of interest to the board, and I think an avenue that the board is interested in, what I'll do is follow up with the board secretary in the office of the general counsel to determine if there's some reason why this policy should not be made public. And if lacking or barring that, then working to make the investment policy public. That concludes my response.
Great. Thank you, Eugene. I would encourage that, and I hope that my fellow board members do as well, just for transparency and letting our stakeholders know how we do derive at some of the decisions that are made. Eugene, I think that from today's presentation that the fund is clearly in a strong position in terms of its overall bottom line. Do you share that assessment with me? Because, again, I think it's in a good position unless there is another black swan event on the horizon, which sadly I'm not a clairvoyant, but for what we're seeing today, is it in a good position?
Yeah, so thanks, Mr. Board Member Hood. This is Eugene, and I would agree that the second quarter 2021 results reflect a solid position overall of the performance of the share insurance fund, and I make that assessment based on the current statistics that we saw today, including the low rate of failures, the fact that there's no significant losses that the fund has seen. There have been no increase to the reserves. The aggregate Camel data is relatively steady. So I think those are all positive signs. As I think all the speakers have mentioned this morning, we do need to continue to be vigilant because we don't know what we don't know. And as you just alluded to, what sort of black swan or other event might be around the corner. I remain concerned about the fact that the projected equity ratio and the actual equity ratio are still below the normal operating level, which does reduce sort of the cushion should one of those types of events emerge. But for these quarterly results, it continues to show a strong financial performance for the fund. That concludes my response.
Thank you, Eugene, and I agree wholeheartedly. The NCU SIF resources, I need to remind folks, are credit unions resources. I believe the board should act on this in November or December to perhaps set the NOL at 1.30%. And ultimately, this discussion should be about what the net operating level of the fund should actually be. What should credit unions get back in dividends? I do have another question, and that is, on what basis should the board adjust the NOL under the current law, Eugene?
This is Myra Tepe. I'll go ahead and take that question. The normal operating level is established in the Act, and it's defined, Board Member Hood, as the equity ratio specified by the Ncua board, and it states that it shall not be less than 1.2 and not more than 1.5%. So the Act, and there's some associated regulations in Part 741.4 that establish the requirement for the board to set the normal operating level. We do actually set the normal operating level, and again, keeping in mind that it's the board's target equity ratio for the insurance fund. We have a policy for the normal operating level that sets out 3 objectives when we set the normal operating level, and that's 1, to maintain public confidence in the federal share insurance. 2 is to prevent impairment of the 1% contributed capital deposit. And 3, to ensure the fund can withstand a moderate recession without the equity ratio declining below 1.2% over a 5-year period. The policy further requires any adjustment to the normal operating level of more than 1 basis point to be undertaken only after public comment is received on the adjustment and the public report is issued supporting the proposed adjustment. And just as a reminder, we recently published, or the NCUA board approved a normal operating level policy request for comment. We're reviewing those comments by staff currently right now. So this concludes my response, sir. Thank you.
Great. Thank you, Myra. Thank you for a very detailed response. I really do appreciate it. I'm going to shift gears a bit. And Eugene, this may be for you, and that is, can you please discuss the driver of the change in net income year-to-date from June 30th, 2021 and June 30th, 2020?
Sure. So as you noted in the question, the net income for June 30th, 2021 improved compared to the previous year 2020 comparative period. And the primary driver of that, overall the income was similar, but the expenses were more favorable this quarter due to an improved position of the asset management estate receivable. So that helped the income position for the Share Insurance Fund this quarter as compared to what we saw last year. That concludes my answer.
Great, thank you. And I do have one last question for you, Eugene, and that is, can you please discuss the unpaid and undelivered orders in the Ncua SIF that's referenced in last year's annual report? For the record, this is more for our stakeholders, just to see the transparency and to hear directly, because I recognize that not everyone has read some of the finer details of our annual report.
Sure. Give me, sorry, just one second on that. Just pulling up my notes. The increase. I'm sorry, I pulled up the wrong note. Okay, I'm sorry, I've got the information now. Asking about the unpaid deliverable orders and some of the outstanding items as reported at the SIF at the end of the year.
Yes, sir.
Yep. Unpaid undelivered orders represents the amount of goods and services that were ordered which have not yet been received and have not yet been resolved with an outlay of cash. So they're bills anticipated that we'll have to pay. These amounts represent unused purchase orders from contracts to support state examiner expenses that are expected to be received or paid in the future, which would have been the first part of this fiscal year. The amount as of December 31st, 2020 also includes unused operating fund overhead transfer amounts, and this amount would have been deobligated in February. The paid undelivered orders represent prepaid amounts of goods and services ordered that have not yet been received, and that amount corresponds to advances and prepayments line on the Share Insurance Fund balance sheet. For both years, the amount of paid undelivered orders includes prepaid legal deposits related to resolution of corporate asset management estate and prepaid amounts for leased laptops and merit training costs. That concludes my response, sir.
Great, thank you. And again, that's more for transparency. So I appreciate your response. And as always, thank you for your hard work and leadership. And I have no more questions or comments. Thank you.
Thank you, Board Member Hood. That concludes our discussion of the Share Insurance Fund's performance in the second quarter. The second item on our agenda today is the 2021 mid-session budget. The Chief Financial Officer, Eugene Sheed, will present. Eugene, you may begin when you are ready.
Good morning again. This is Eugene Sheed, and I am here for this item to present the 2021 mid-session budget review for the NCUA's operating budget, capital budget, and Share Insurance Fund administrative budget. This also includes proposed revisions to the 2021 operating budget. Slide 2. Slide 2 summarizes year-to-date spending from the operating budget through July 31st, 2021. It also shows my office's projections as to where the NCUA will end up at the end of the year by major budget category for pay and benefits, travel, rent, communications and utilities, administrative expenses, and contracted services. Based on the July year-to-date spending and a review of historic spending trends, the 2021 operating budget is projected to end the year with a budget surplus of approximately $15 million. This projection is exclusive of board decisions to adjust the budget. Nearly two-thirds, or approximately $9.9 million of the projected surplus, is due to significantly lower employee travel in 2021 because of the pandemic-related travel restrictions. Of the remaining amount, approximately $2.8 million is a projected surplus that results from lower estimated employee compensation due to relatively lower staffing levels than projected in the budget, and approximately $2.3 million of projected surplus that results from lower estimated spending in non-compensation budget categories based on a review of historic spending trends. Slide 3. Slide 3 shows the status of $20.5 million in 2020 carryover budget balances that the Ncua board approved for spending in 2021 as part of its action on the 2021 budget. The board instructed in December 2020 that the CFO provide an update at mid-session, which is what this is. Of the amount provided by the board, the staff estimates that approximately $8.6 million will be required for the surge workforce, COVID-related expenses, and costs, leaving a balance of approximately $13.7 million that may not be required for uses approved by the board before the end of 2022. However, this projected surplus may decrease if additional rehired annuitants are brought on or if additional contract support is required in the event of emergent issues. In summary, when combined with the projected surplus from the 2021 operating budget, approximately $28.6 million in excess budget is currently projected for 2021, absent any reprogramming actions that the board may take. Slide number 4. The next couple of slides present consideration for the board of some reprogramming actions. Slide number 4 summarizes the recommendation to add 7 new positions to the Ncua budget. 3 cybersecurity-related positions will help the Ncua strengthen and coordinate cybersecurity operations in critical infrastructure matters. A new cybersecurity coordinator will be in the Office of the Executive Director. A cybersecurity operations and service delivery manager would both be added, if approved, to the Office of the Chief Information Officer. 1 new position for the board secretary will ensure the efficiency of board operations. And 3 new positions in the Office of Ethics Counsel will improve the agency's compliance program for employee ethics, laws, and standards. These positions include an ethics attorney, ethics specialist, and staff assistant. Slide 5. Slide 5 discusses the costs for the 7 new positions, which will be very minimal in 2021, since the new employees would be anticipated to be hired late in the year and can be funded with the existing employee pay and benefits budget already approved by the board for 2021. The full cost of all 7 positions in 2022 is estimated to be approximately $1.9 million. Slide 6. Slide 6 summarizes a number of non-personnel proposals and requirements that have arisen since the start of 2021 for board consideration. $906,780 would pay for cybersecurity support for Ncua systems, services, and information holdings. Within this total of $906,000, $560,000 is recommended to provide support for the Ncua's security operations, such as implementation of federal information security mandates, support for information security governance, risk and compliance programs, software patch management, and security support specific to Ncua applications. $200,000 is recommended for an independent third-party cybersecurity review of the Examinations and Supervision Solution and Information Hosting, ESS and IH program, which will provide additional security assurance to Ncua as it rolls out Merit and its supporting applications to the entire agency and the credit union industry. And finally, for the Chief Information Officer, $146,000 is recommended to acquire expert-level support for Ncua's information technology and assurance staff to accelerate the adoption and usage of secure cloud technology and optimize investments already made in the M365 to replace duplicate capabilities where possible. An additional $939,000 is recommended for employee relocation expenses. The approved 2021 budget for employee relocation is $750,000. However, the number of employees expected to relocate has increased as compared to 2020. Upon which the budget was estimated. An additional $550,000 is recommended for two important human capital analytics efforts. Of the total, $300,000 will support analysis of the Ncua compensation plans. This will help the agency avoid staff who this will help fill the void of staff who have left the agency, which helps to offset the cost of this proposal. The remaining $250,000 will support analytic and consultative work about the NCUA's diversity, equity, and inclusion programs, practices, and impacts on compensation. And finally, an additional $40,000 is recommended for new executive briefing and analysis support, which will provide daily comprehensive reports to summarize information relevant to the NCUA on the economy and financial services industry. In addition, the board has approved a leave payout for 2021 that is specific to 2021. This payout is estimated to cost up to $1.6 million, but will likely be lower. The action will liquidate a portion of the NCUA's 2021 liabilities for eligible employees' earned leave and reduce the agency's anticipated end-of-year leave balances. The grand total for all recommendations and the leave payout is approximately $4 million as shown on the table at the bottom. Slide 7. Slide 7 summarizes the information I have just discussed. The 2021 operating budget surplus and the 2020 carryover that when combined together, totals $28.6 million, absent any budget adjustments. As I described on the previous slide, the recommended mid-session proposals and the leave payout total approximately $4 million. As shown on this table, the residual estimate year-end budget surplus is $24.6 million, if the mid-session proposals were to be approved by the board. Slide 8. Slide 8 is a summary of the board-approved 2021 capital budget in year to date July spending and available balances. The spending is in line with historic patterns, and unspent balances to date are anticipated to be used for the projects approved by the board as they move towards completion. Slide 9. Slide 9 summarizes the Share Insurance Fund administrative budget and the year-to-date spending through July. A $1.7 million surplus is estimated because there has been no spending for state examiner training and travel costs due to COVID restrictions. I'll conclude my presentation by summarizing the recommended actions presented for the board today. To reprogram $906,000 from travel surpluses to contract services for cybersecurity and related CIO needs. To reprogram $939,000 from projected travel surplus to help pay for current and anticipated employee relocations in 2021. $550,000 reprogrammed from travel to pay for additional human capital analytics support. $40,000 reprogrammed from projected travel surplus to contracted services to pay for executive briefing and analysis support, and the approval of 7 additional positions. Thank you for your time today, Mr. Chairman, Mr. Vice Chairman, and Board Member Hood. This concludes my remarks on the 2021 mid-session budget. Slide 10 has my contact information, and at this time I would be happy to answer any questions that you have.
Thank you, Eugene, for your mid-session briefing on the 2021 budget and proposed revisions. I always appreciate your team's careful attention to these important matters. While we project that year-end spending on employee pay and benefits is largely on track, we anticipate spending much less than budgeted for non-employee related expenses. Even though we pared back our estimated travel spending in the 2021 budget, the ongoing COVID-19 pandemic has severely restricted our ability to return safely to on-site examinations at federally insured credit unions. As a result, we now project a year-end surplus of nearly $15 million. Like a hardworking family living on a budget who receives an unexpected windfall, this surplus presents the NCUA with an opportunity. Should we save it for a rainy day? Should we use it to fix our infrastructure? Or should we make sensible investments to address important short-term and long-term needs? Each of these options is reasonable. There is, however, one certain thing. We should not splurge. As a steward of the credit union system, the NCUA board has a responsibility to spend and save these extra dollars wisely, but at the same time, too, meeting our mission objectives set out in the Federal Credit Union Act. Credit union members are counting on us to get it right and to use restraint so that their credit union will send fewer dollars to the NCUA. With such savings, members might receive slightly more interest on their share deposits and pay slightly less interest on their mortgages and other loans. The proposed changes to the 2021 budget and staffing levels make prudent investments and pragmatic commitments aimed at achieving important policy goals related to cybersecurity, ethics, agency operations, and workforce diversity, equity, and inclusion. Even after making these changes, the agency will have a residual budget balance of approximately $24.6 million from the 2020 and 2021 budgets, which the NCUA can use to offset future budget needs. Since the start of the year, there has been a steady stream of cyber attacks. On several occasions, hackers have used ransomware to abruptly bribe companies and large sectors of the U.S. economy to a halt, including those in the financial services industry. These risks are likely to continue and accelerate. As such, national security officials and agencies across the federal government have made stopping these cyber attacks a priority by instituting new policies and procedures. To protect the information that the NCUA maintains and to strengthen our defenses, we need to comply with these new government-wide mandates. Not only do we need to adjust our operations, adopt new procedures, and implement reforms, we also need to hire 3 new cybersecurity professionals. One of these new positions will organize, coordinate, and advise on cybersecurity and critical infrastructure matters across all NCUA offices. Once selected, this leader will improve the NCUA board's understanding and policymaking related to cybersecurity issues. Additionally, the mid-session budget revisions complete a process begun under Chairman Hood, whose able leadership created our Office of the Chief Ethics Counsel to certify the agency's compliance with relevant federal ethics laws and regulations, promote accountability and ethical conduct, and ensure the success of the NCUA's ethics program. The Office of the Chief Ethics Counsel needs 3 additional slots. By incorporating these positions into the baseline workforce count, instead of keeping them in the overhires and outside of the official employee tallies, we are presenting a more realistic picture of the agency's actual resource and human capital needs for the credit union system. The final position would add a deputy in the board secretary's office. Our board secretary has long been under-resourced. The volume of work exceeds the capacity of the 2 positions currently assigned to this function, and there are limits on the type of work that can be delegated. Moreover, a deputy position provides additional backup and will aid in succession planning for this essential agency function. I am very supportive of this sensible change. Finally, there are 2 other mid-session budget initiatives related to human capital. One project will conduct an analysis of the NCUA's compensation plans. This study will help ensure that the agency determines equitable compensation adjustments in future years as it engages in contract negotiations with the NTEU. And the second project will support analytic and consultative work about the agency's diversity, equity, and inclusion programs and practices. I am very supportive of both of these initiatives. In closing, I support the mid-session budget revisions and thank my colleagues for working together to adopt them today. That concludes my remarks. Vice Chairman Halpman, you are recognized for your comments.
Thank you, Mr. Chairman. I would say, actually, thank you, Eugene, for the mid-session briefing. The 2020 mid-session budget briefing was delivered at the July board meeting, and given the massive and unforeseen challenges last year, that was quite an accomplishment. I hope the timing of the 2022 mid-session budget briefing is closer to what we would expect for mid-session. I want to comment on the allocation of additional resources to the Abrams agency's cybersecurity efforts. The Chairman spoke about this as well. The trend of cyber attacks that began in 2020 has shown no signs of slowing down this year. Colonial Pipeline, SolarWinds, the NBA, the insurance companies Access, CNS, the software platform Kaseya, the computer manufacturers Acer, Quanta were among the many targets of hackers this year. None of us want to be the weak link when it comes to cybersecurity. It is more critical than ever to quickly identify threats, protect data, be prepared to safely recover when things go wrong, and to assure operations remain intact under any threat. That said, I am concerned we're voting on something so critical with barely a week to review. As a board, it's imperative that the board regularly receives and reviews comprehensive information on our cybersecurity efforts. So I would like to call my fellow board members to ask our staff to ensure we're regularly provided this comprehensive info on our IT and cybersecurity preparedness. The final reason cybersecurity is so important is because NCUA is constantly stressing to credit unions the importance of their cybersecurity. thus it is obviously incumbent upon Ncua to walk the walk and protect our own systems. That concludes my remarks. I just have one question for Eugene regarding the mid-session budget as a whole. Can you walk us through what happens to surplus funds? What is the policy with surplus funds?
Sure. So this is Eugene, and as the presentation's identified, there's almost $25 million at this point estimated to be surplus. What we've done is we work with the board to develop an upcoming budget, is to estimate, to revise that estimate as we work through the budget process, so to update the $25 million as we get more information later in the year, and then to present that for the board's consideration in how to use it for the upcoming budget process, which in recent years has been to essentially lower the future budget and sort of the additional budget that we have to collect via the operating fee that we assess to federal credit unions, and reduce sort of any new draw, any new budget requirement that would also come from the overhead transfer rate. So in short, we work with the board to identify what those estimates would be and how best to apply them to offset the future year budget, similar to what the chairman alluded to. That concludes my response.
Detailed response. Always great to hear the word surplus and see the good we can do for the Share Insurance Fund. That concludes my questions. Back to Chairman Harper.
Thank you so much, Mr. Vice Chairman. And one thing that I do want to comment on, I have asked the Executive Director's Office as we're rolling out these cybersecurity reforms to make sure that we as board members get monthly, at least written updates, and at least quarterly, and of course more frequently, if needed, in-person sessions, because I do think it's important that we all stay on top of these issues. Board Member Hood, I also want to thank you for your contributions to developing this mid-session budget. Please feel free to begin your remarks.
Great. Thank you, Mr. Chairman. And Eugene, you're in the final stretch. I recognize that you now have been speaking for a little over an hour. So again, final stretch for you. First, I want to say that I do think it is great news as we look at today's mid-session budget, and that we are seeing a residual budget balance, or better known as a surplus. And as we look at this surplus, I want to say that as staff is drafting the 2022 budget now, I would certainly like to see staff develop a budget that controls costs and gives funds back to credit unions in some form or fashion, rather through a direct payment or some type of offset. And additionally, I'd like for it to be known that I can't support a 2022 budget if it doesn't holistically review the operating fund, something that I've talked about in previous board meetings, and something that has grown quite substantially and dramatically. In fact, the operating fund cash position has now increased to well over $100 million. So I say it begs the question of how much of this is actually needed. But I will be supporting today's mid-session. Eugene, I do have one or two quick questions. One, the cybersecurity piece, and for all the reasons that the chairman and vice chairman have articulated, cybersecurity is incredibly important. Thank you, Chairman Harper, for recognizing that it was a priority for me when I became chairman 2 years ago, so much so, in fact, that I wanted to make sure that we had a senior advisor dedicated to all things cyber. And to your comments, Vice Chairman Haltman, the sign of cyber attacks are showing no signs or signals of abating. We must continue to remain vigilant and steadfast in battening down our defense mechanisms. And just as we are encouraging our credit unions to invest in cyber and to do all the necessary work to protect their institutions and their members, we too at NCUA are doing that as well. So delighted to know that we are going to be continuing to build out our cybersecurity program. Very excited, though, Eugene, if you could talk about how, yes, we are increasing the number of positions, but please let stakeholders know that we already have folks devoted to cybersecurity as well in-house. I don't want them to think that we're starting from scratch. Can you talk about a little bit about that, please?
Yes, sir. And I guess helpful to clarify from my presentation, certainly these, both the contractual resources that I identified relative to improving, bolstering cybersecurity efforts, as well as the staff, are to sort of further complement, strengthen the program that NCUA currently has and has been building. So In both cases, we've got within the CIO's organization contracts for which these additional funds would be additive, so they're not new efforts. And obviously, within the CIO's organization, there's already parts of the organization dedicated to cybersecurity and information security, and these would be important additions given all the reasons that the board members have articulated in terms of just the pervasiveness in the severity and the frequency by which we see incidents happening in the industry and in government, and wanting to make sure that all avenues within NCUA are covered. Obviously, it's an area for which we have a very low risk tolerance, and so we're ever mindful about making sure that we have the right resources for those programs. That concludes my answer.
Yes, critically important that we have those resources, Eugene, especially as we, on one hand, talk about the advantages of fintech and how it really can accelerate financial inclusion and other things that we are looking at fintech to provide. I recognize that with the support of fintech comes even a greater need for working around cybersecurity issues. So thank you. Then a second question, you referenced the DEI spend in the budget. Of course, I have advocated and been a champion for diversity, equity, and inclusion well before coming here to NCUA, but I'm delighted to know that we are marshaling a lot of our resources in that area. But could you talk specifically about the DEI spend in the budget? And I also believe it somewhat relates to a recent executive order.
Sure, thank you. I'd be glad to elaborate a bit on that. So this is Eugene again. The NCUA's, as you're aware and you've alluded to, Mr. Board Member Hood, the NCUA's long been active in conducting DEI-related programs and activities, especially as it relates to our requirement, longstanding, certainly pre the executive order, Section 342 of the Dodd-Frank Act. And a significant number of these DEI programs, including internships, recruitment and outreach, professional training and development, equity for employment with people with disabilities, all are a part of the program that NCUA has, and also dovetail with parts of the executive order. However, I would say that we have not adjusted our budget or our activities directly as a result of the executive order. Rather, these are reflective of kind of our longstanding agency commitment in programs that we have for DEI. That concludes my answer, sir.
Great. Thank you again, Eugene. And again, I really appreciate your leadership. And then I just want to close with this. We were given a little under a week. In fact, Eugene, I think it was your office that briefed me on Monday. So from Monday's initial review of the budget to getting here today. So I know that this perhaps was beyond your control, but I would just like to ask if we could continue to perhaps go back to where the board items were, I guess, a few years ago. I know when I returned that the board offices generally ask for about 2 weeks for the board offices to review regular items and a month for such items such as subordinated debt. And I just think that, that's a good framework. And while there would be exceptions, it should be followed when possible to allow the board offices ample time to deliberate and prepare for the board meeting. So I know Vice Chairman Haltman, you alluded to that as well. Short time to really even review some of the cybersecurity aspects. So I just hope that going forward that this can be improved so we can avoid the unnecessary rush that may cause inevitable mistakes when we are all operating on such short notice. But again, I will be supporting today's mid-session budget. Thank you, Eugene, and thank you, Mr. Chairman, for giving me the floor.
And Board Member Hood, I completely agree with you that we need to give offices sufficient time in order to digest this. I will tell you that oftentimes I don't get material until very late. And above and beyond that, there are times when I have said, we can't move forward with a particular rule because I've not seen it and other board offices need to see it beforehand. We need to digest it. I want to make sure that everybody does have the amount of time necessary to review and to feel comfortable with the material that we're presenting. Vice Chairman Haltman, I believe that you have a motion.
Yes, sir. I move that the board approve, number one, reprogramming $906,780 from the projected 2021 travel surplus to the contract services budget to pay for additional cybersecurity support. 2, reprogramming $939,686 from the projected 2021 travel surplus to the administrative expenses to pay the administrative expenses budget to pay for anticipated employee relocations. 3, reprogramming $550,000 from the projected 2021 travel surplus to the contracted services budget to pay for additional human capital analytical support. 4, reprogramming $40,000 from the projected 2021 travel surplus to the contracted services budget to pay for executive briefings and analysis support. And 5, 7 additional full-time positions, 2 for the Office of the Chief Information Officer to provide additional cybersecurity expertise and capabilities, 1 for the Office of the Executive Director to coordinate cybersecurity activities and programs internal and external to Ncua, 1 for the Board Secretary to ensure efficient Ncua board operations, and 3 for the Office of Ethics Counsel to improve the Ncua's compliance programs for ethics laws and standards, all as detailed in the Board Action Memorandum.
Thank you, Vice Chairman Hauptman. Is there a second for the motion?
I second.
Thank you. There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. The third item on our agenda today is the Oregon Member Business Lending Rule. The staff presenting are Sherry Freed, Regional Director, Western Region, and Julie Case, Associate Regional Director of Operations, Western Region. Sherry, you may begin.
Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. This is Regional Director Sherry Freed. We are here today to request approval of federally insured state-chartered credit unions in Oregon to be exempt from Ncua rules and regulations, Part 723, and follow the June 28, 2021 revised Oregon Member Business Loan Rule as permitted in Section 723.10A of the regulation. The Ncua MBL rule was reviewed back in 2016 as part of the Regulatory Modernization Initiative, including modifying, streamlining, refining, or repealing outdated regulations. This modernized the regulatory requirements that govern credit unions' commercial lending activities by replacing the former rule's prescriptive requirements and limitations with a broad principles-based regulatory approach. It provided federally insured credit unions with greater flexibility and individual autonomy in safely and soundly providing commercial and business loans to serve their members. The revised rule went into effect in January 2017. The final MBL rule allowed for grandfathering of existing state rules approved by the Ncua. However, a state supervisory authority must seek Ncua's board approval to adopt variances from these rules the board previously approved. The Ncua board originally approved the Oregon MBL rule on June 20th, 2002. The Oregon Department of Consumer and Business Services submitted a request for the Ncua board to approve their proposed revision to the Oregon MBL rule on June 28, 2021. The Western Region, with the concurrence of the Office of General Counsel and the Office of Examination and Insurance, found the final revised Oregon MBL rule to be substantially similar and no less restrictive than Ncua's Part 723 as permitted by the regulation. As of June 30th, 2021, the state of Oregon has 55 federally insured credit unions, of which 20 are state chartered. In aggregate, the net worth ratio in state-chartered credit unions in Oregon has declined due to strong asset growth during the pandemic, but is still strong at 9.7%. Oregon credit unions also continue to have a strong return on average asset ratio of 1.16%. In aggregate, commercial loans account for 57.66% of net worth, with a very low commercial loan delinquency and net charge-off ratio. We do not expect the 2021 Oregon MBL rule as proposed to cause future safety and soundness concerns. We recommend the Ncua board determine the Oregon MBL rule, otherwise noted as OAR 441-720-0300 to 441-720-0380 at least covers all of the provision and is no less restrictive than Part 723 of the NCUA regulations. This concludes our presentation, and we would be happy to answer any questions you may have at this time.
Sherry, thank you for your presentation, and Julie, thank you for being available for questions on the Oregon Member Business Lending Rule. The issue before the NCUA board is whether the Oregon MBL rule at least covers all of the provisions and is no less restrictive than Part 723 of the NCUA's regulations. I support the staff's determination that the Oregon Member Business Lending Rule at least covers all the provisions and is no less restrictive than the NCUA's rules. In late June, the Oregon Department of Consumer and Business Services submitted a request to the NCUA board to determine whether the state's revisions to the Oregon MBL rule would meet the standards specified in Section 723.10A of the NCUA's regulations. Under this section, federally insured state-chartered credit unions in a given state are exempt from compliance with Part 723 of the NCUA's rules if, quote, the state supervisory authority administers a state commercial and member business lending rule for use by federally insured credit unions chartered in that state, provided that the state rule at least covers all provisions in this part and is no less restrictive upon determination by NCUA. Under a similar provision in an earlier version of Part 723 of NCUA's rules, the NCUA board determined in June 2002 that Oregon's current MBL rule for federally insured state-chartered credit unions in the state met the exemption standard. The NCUA has since revised its MBL rule, and Oregon has now updated its regulation to address the changes made by the NCUA board. The Western region, with the concurrence of the Office of Examination and Insurance and the Office of General Counsel, now recommends that the NCUA board determine that the revised Oregon MBL rule at least covers all of the provisions and is no less restrictive than Part 723. Sherry, would you please confirm that this amended Oregon MBL rule is no less restrictive than the requirements in the NCUA's member business lending regulation?
Yes, Chairman Harper, this is Sherry. We did a very detailed side-by-side comparison and also worked with our state counterpart on clarification since the time the NCUA rule was updated. They're revising all sections of their current rule to be no less restrictive than our regulation. As indicated, the Office of Examination Insurance and the Office of General Counsel concur with our assessment. Back to you, Chairman Harper.
Thank you so much, Sherry. And Sherry, as I understand, while the rule needs to be no less restrictive, in fact, the Oregon member business lending rule in some ways is more restrictive than the NCUA rule, particularly in areas of risk classification, policies and procedures, and borrower concentration limits. Would you detail a little bit more about those issues for us?
Yes, Chairman. This is Sherry again. For the risk classification, the Oregon proposed rule is detailing exactly the defined risk classifications of special mention, substandard, doubtful, and loss. NCUA regulation does not specifically require this defined industry-used grading system. And for the credit union policies, they're more prescriptive on the requirements that must be included in the policy. For example, file documentation expectations, expectations for collateral determination, and specific credit risk management procedures. And for the question on the borrower concentration limit, NCUA has an aggregate lending limit for a commercial loan to member or associated borrowers. The Oregon proposed rule states that this limit includes all outstanding loans, not just the commercial loan. So that answers the question, and back to you, Chairman Harper.
Thank you so much, Sherry. Today's action by the NCUA board will make the examination and supervision of federally insured state-chartered credit unions in Oregon more efficient in that one regulator, instead of two, will examine for compliance with member business lending rules. Our determination today also demonstrates how federal and state regulators can work together as partners. Once again, I support the determination that the Oregon MBL rule at least covers all of the provisions and is no less restrictive than the NCUA regulations. That concludes my remarks. I now recognize Vice Chairman Haltman.
Thank you, Mr. Chairman, and thank you to Sherry and Julie for your presentation. I'm glad we are addressing this as it gives the state chartered credit unions in Oregon greater clarity. Our job at NCUA is to protect the Share Insurance Fund, and it's definitely not to make things harder for state chartered credit unions. More regulatory clarity is always helpful. And I think wherever possible, we want to not put our thumb on the scale and make state charter any worse of an option. State chartering is one of the only forms of quasi-competition we get at NCUA, and that any form of competition helps with our overall performance. I'm aware that years ago, these sorts of requests were approved by the regions. It may be worth considering returning some power to the regions for decisions like this. It's not that there's anything wrong with the board approving this request today. Just as a general matter, decisions are best made by those closest to those affected. It's provided our Office of General Counsel is comfortable that such a delegation is within the board's authority. Thank you, Mr. Chairman. That concludes my remarks, and I have no questions. Back to you.
Thank you. Board Member Hood, you are now recognized.
Great. Thank you, Mr. Chairman. And thank you, Sherry, for your presentation this morning. And it was good seeing you and Julie both I guess on the screen for this week's briefing. I will be proudly supporting today's rule because as a former commercial lender, I recognize firsthand the role that business capital plays in stimulating the American economy and helping those small businesses have access to the capital they need for equipment, payroll, whatever the cases are, but for them to thrive in today's economy. And importantly enough, recognizing that during the pandemic and the recovery, we're going to need to really find ways of making business capital available. So I'm glad that today's board action is going to make that even more possible for those credit unions that are engaged in member business lending there in Oregon. I believe also that what we're proposing today, this principles-based approach, it certainly does align with my regulatory philosophy of regulation needing to be effective and not excessive. With that being said, I was very pleased to see that a lot of the state chartered credit unions there in Oregon played a key role in making PPP loans when they were needed most. In fact, as of June 30th, 2021, the Oregon State Chartered Credit Unions had over 6,388 PPP loans for an aggregate of $134.6 million outstanding. And then based on that call report, 12 of the 20 state charters have outstanding loans that we're seeing for 2021. And it shows that the program is certainly assisting their members. I would note that there are 7 states that have their own MBL rule currently. It's not widely used, but just wanted to note that. And the NCUA does not have this rule for other types of lending products. So I just note that. But I have no questions. And again, delighted to know that we're going to be providing transparency, clarity for those credit unions in Oregon so they can, again, help business owners get the capital they need. Thank you.
Thank you, Board Member Hood. Is there a motion?
Yes, I move that the board approve the determination that the Oregon Member Business Lending Rule, as attached to the board action memorandum, at least covers all of the provisions and is no less restrictive than Part 723 of the NCUA's regulations.
Is there a second?
I second the motion.
There is a sufficient second. All those in favor say aye.
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 Aye. All those opposed say nay. The ayes have it, and let the record show the motion passes 3-0. The fourth item on our agenda today is the 2021 NCUA Board Agenda. Board Member Hood, you are recognized to present the item and may begin.
Thank you, Mr. Chairman. Today's rule schedules consideration for 3 important final items that will strengthen the credit union system for continued success and really allow credit unions to continue serving the needs of the 1/3 of American households that are members of credit unions. First, a final rule on credit union service organizations, Part 712, to be placed on the NCUA board agenda on the October 21st, 2021 board agenda. Second, a final rule in the field of membership shared facility requirements, Part 701, Appendix B, on the November 18th, 2021 board agenda. And finally, a final rule on mortgage servicing rights, Part 703 and 721, to be placed on the December 16th, 2021 board agenda. We should consider these final rules and let the board work its will in bringing them to fruition. Today's board action memorandum is co-signed by Vice Chairman Hauptman, and I'd like to thank him for this support. In speaking with the Chairman's Chief of Staff, I believe that we may be able to reach consensus on some of these items. Again, and some, and perhaps not all, in a bipartisan fashion if we work hard enough to do so. So I certainly look forward to doing so. And I'd just like to repeat what the chairman said when he first became chairman, and I certainly like this quote where I quote Mr. Harper, "Moreover, I will prioritize open engagement and seek win-win compromises whenever practicable, negotiating in good faith with an open mind and open communications is how I would lead the NCUA." And I end Mr. Harper's quote. And Mr. Harper, it is in that vein of open-mindedness, open communications, and win-win compromises that I hope that we can all work with you in bringing these matters to fruition. Thank you.
Thank you very much. Vice Chairman Hauptman, you are now recognized for your statement.
Thank you, Mr. Chairman, and thank you, Board Member Hood, for your work on this item. It goes without saying there's a lot of significant issues facing this board. As a result, focus is almost a luxury. But getting caught up in urgent items at the expense of important items is a trap we should always avoid. The Chairman's office works diligently, and I appreciate the support my office has received during our 10 months here. And I also understand that scheduling items this far out isn't always possible or effective. But, Mr. Chairman, I look forward to working with you and your staff to move other important issues forward in a timely way. That concludes my remarks. I have no questions. Back to Chairman.
Thank you, Vice Chairman Hauptman. Thank you, Board Member Hood, for presenting this board action memorandum to set specific dates by which the Credit Union Service Organization final rule, the Field of Membership Shared Service Facilities requirements final rule, and the Mortgage Servicing Rights final rule will be added to the NCUA board meeting agenda for October, November, and December, respectively. Although I will not support this action because I believe that crafting good rules should not be rushed, I want to be clear that to me, this item is not a contentious one. There are times in many negotiations where the parties find themselves at an impasse. When that occurs, there are often processes that exist to move beyond the impasse while protecting everybody's positions and everyone's rights. We have such rules built into our board procedural regulations, in fact, and that is how I view this agenda item on agenda items. It should, however, come as no surprise to anyone that my policy positions on these three rules have not changed since they were first proposed. In my view, the CUSO rule would be the wrong rule at the wrong time. The current economic environment in which we live, we should be focusing on the rules to protect consumers and prepare the system for potential credit losses once the COVID-19 pandemic relief programs end. The CUSO rule is not related to providing COVID relief to credit union members, and it is more likely in the long run to harm small credit unions than it is to help them. What is more, in issuing the final CUSO rule, we would be abdicating our statutory duties to serve as stewards of the credit union system. This proposal would grow an already unregulated space within the credit union system with little accountability for protecting consumers and credit unions. If I have learned anything about financial services regulation during the last quarter of a century, it is that scandals and crises grow out of regulatory blind spots like the one this rule would create. Further, the Financial Stability Oversight Council, the Government Accountability Office, and the NCUA's own Inspector General have all called for the agency to have vendor authority to oversee CUSOs and other third-party vendors. And the top 5 CUSO providers provide services to nearly 67% of the total credit union system assets. A failure of even one of these vendors represents a significant potential risk to the share insurance fund. And while I support expanding access to affordable financial services for people of modest means and diverse backgrounds, I could not support the field of membership shared facility proposed rule. In my view, the proposed rule and request for comment did not conform to either the letter or spirit of the Federal Credit Union Act. However, I do believe that if the board reaches consensus, and I think it might be able to, on remedying these deficiencies, there could be a path forward. Finally, in voting against the mortgage servicing rights rule proposed in December, I stated that I was not necessarily signaling my opposition to moving ahead with a final rule. Instead, if the final rule contains appropriate and substantive guardrails to mitigate inherent risks in mortgage servicing, I could support a final rule. And I know that we did ask questions that would allow us to potentially add those guardrails now. Today, I am optimistic that the board will find that consensus, as we do on many other items, certainly on all the items that we have considered today. That concludes my comments. Vice Chairman Hoffman, do you have a motion?
Yes, sir. I move that the board approve the 2021 board agenda as detailed in the board action memorandum.
Is there a second to the motion?
I second.
There is a sufficient second. All those in favor say aye.
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 All those opposed say nay. Nay. And let the record show that the ayes have it and the motion passes 2-1. The fifth and final item on our agenda today is proposed rule parts 702 and 703, subordinated debt. Staff presenting are Tom Fay, Director, Division of Capital Markets, Office of Examination and Insurance, and Justin Anderson, Senior Staff Attorney, Office of General Counsel. Accompanying them in answering questions are Myra Tepe, Director, Office of Examination and Insurance, and Tim Sagerson, Deputy Director, Office of Examination and Insurance. Tom and Justin, please begin when you are ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, Board Member Hood. This is Tom Fay from the Capital Markets Division of the Office of Examination and Insurance. As you mentioned, Chairman, joining me is Myra Tepe, Director of Office of Examination and Insurance, Tim Segerson, Deputy Director of the Office of Examination and Insurance, and Justin Anderson, Senior Staff Attorney from the Office of General Counsel. We are here today to present for your approval a notice of proposed rulemaking, or NPR, to amend the final subordinated debt rule, which is effective January 1st, 2022. We propose a 30-day comment period for this NPR. The proposed change will assist eligible credit unions in the transition to the new subordinated debt rule as it relates to 2021 approved secondary capital plans and the investments into those credit unions emanating from U.S. government programs. And one program, for example, is the Emergency Capital Investment Program, or ECIP, that invests into minority depository institutions, or MDIs, or community development financial institutions, CDFIs, credit unions. Given the complexity and due diligence required to complete the ECIP investment process, there is a possibility that the actual issuance may not occur in 2021 and extend into 2022, parallel to the effectiveness of the new subordinated debt rule. Justin will discuss the details of this proposed amendment to the subordinated debt rule to accommodate this scenario following my remarks. The ECIP program, established by the Consolidated Appropriations Act 2021, was created to encourage low and moderate income community financial institutions to augment their efforts to support small businesses and consumers in their communities. Eligible financial institutions include MDIs or CDFIs who are federally insured credit unions and are not designated in troubled condition. Congress has appropriated a total of $9 billion for the ECIP program, and there are set-asides at different levels of total assets. Eligible credit unions were required to submit an ECIP application to Treasury. The deadline for this application was September 1st, 2021. This was extended a couple of times over the course of 2021. Once approved, Treasury will invest in the form of subordinated debt into those credit unions in accordance with the prescribed term sheet of the transaction. Details about the ESIP program can be found on Treasury's ESIP website. Credit unions who also have a low-income designation, like you, can separately apply for secondary capital treatment. An approved plan provides like you credit unions with the ability to augment their net worth for the purposes of their PCA classification. Given the complexity of a potential dual application process, including the ESIP application to Treasury and the secondary capital application, NCUA is working with Treasury and state supervisors, when applicable, in managing the application and decision process. This concludes my remarks, and I will now hand it over to Justin, who will discuss the amendments to the rule. Thank you.
Thank you, Tom. Good morning. This is Senior Staff Attorney Justin Anderson. Currently, the subordinated debt rule contains a requirement that any secondary capital that is not issued by January 1st, 2022 will be treated as subordinated debt and subject to the requirements of the rule. In the context of today's presentation, this provision would require like-yous to reapply for regulatory capital treatment if the investments under the ESIP or other government programs are not funded by year's end. To address this issue, the proposed rule Tom and I are presenting would make two very narrowly tailored changes. First, the proposal would amend the term grandfathered secondary capital to include any secondary capital that is, one, being issued under a secondary capital plan that is approved by the Ncua before January 1st, 2022, and two, being issued to the U.S. government